All right. Well, I think it's the top of the hour, 2 o'clock. I'm sure everyone is super excited to spend some time talking about the tax update for 2020. We're happy that y'all are here. It's not quite the same as our normal CPE session, where we're usually in the movie theater and maybe sharing in a couple of adult refreshments as well. But 2020 has been different for all sorts of things. So hopefully we'll get back to that for 2021. But for now, our update on 2020 is just a Zoom call, just like everything else and that you guys do every single day. So, but we really appreciate everyone joining. We've got a lot of information in these slide decks. We probably will not read every bullet point on every slide. There certainly is some of it there kind of for your reference for, after the fact. Presenting the day along with myself, Jon Rausch, partner here at Holtzman, leading the tax practice. And I've also got Kevin Halls helping me out this year. Kevin's a manager in our practice, joined us a couple of years ago as well. So we thought it'd be better to hear two voices than one for the next 50 minutes or so. So we'll kind of tag team and go back and forth a little bit throughout the presentation. So again, thanks for joining, and we'll go ahead and, I guess, Kevin, if you could advance the slide, I'll just maybe walk through the agenda.
First one, we have an intro from Chris Perkins.
Oh, okay. Yeah, thank you. Intro from the managing partner, Mr. Perkins. So we'll do that first, and then we'll jump in.
Hello, I'm Chris Perkins with Holtzman. Welcome to the second installment of our 2020 virtual CPE series. I hope you get value from these presentations that are delivered in hour-long segments for your safety and convenience. Holtzman's been around since 2004, serving clients in Austin and across the country with our IT, audit, tax, and consulting solutions. Our tax practice has grown rapidly under the leadership of Jon Rausch. Today's tax update session is being led by Jon. Jon's got over 25 years of tax experience and serves clients of all sizes across a variety of industries, including tech, CPG, manufacturing, and real estate. He focuses on federal and state tax consulting, compliance, and planning. Prior to joining Holtzman, Jon served as a managing partner of a large regional firm's Austin branch, and prior to that, he was a partner at Grant Thornton. Jon got his BS and MA in accounting from the University of Missouri at Columbia. Joining Jon today in leading the session is Kevin Halls, a manager in our group. Kevin's got 8 years of tax experience and began his career at a large regional firm in Houston, where he worked on federal and state tax compliance engagements. In 2016, Kevin moved to Austin, honing his skills in federal and state tax compliance. He joined us in early 2019, and we're ecstatic to have him on board. Kevin earned his BBA in economics from Texas Tech University. He's a licensed CPA and a member of the AICPA and the TSCPA. I hope you guys enjoy this 2020 tax update, and thanks for tuning in.
All right, thank you, Chris. Our agenda that we've got up there on the screen, like I said, we've got six or so areas to cover. Honestly, each one of them probably could warrant an hour session all by itself. There's just a lot of information. As we all know, 2020 was a crazy year, and it was really no different in the tax world. Lots of things going on, went on, and currently going on. So I have a feeling if we had this update, a month from now or 2 months from now, there would be even more things to probably talk about. So, as we see the PPP information, Kevin's going to walk through that a little bit, talk about some of the rules, some of the new rules, that revenue rulings and rev procs that have come out here real recently. So we're going to walk through that for a bit. We're going to touch on opportunity zones, which is not really solely a 2020 issue. It came when the Tax Cuts and Jobs Act from a couple of years ago, but it feels like it's really getting traction, that idea. And we wanted to just touch on that, and it's really a nice planning item if your facts and circumstances, fit the bill. We'll touch on Wayfair 2 years later. 2 years ago, that was the big bomb in the sales and use tax and state income tax nexus world. We'll kind of go over a little bit of that, where we sit a couple years after the fact. The CARES Act tax planning, I'm going to talk a little bit about some of that. Again, that alone could probably be an 8-hour session, but we've tried to just glean out a few of the items we felt were important from an income tax perspective. We'll hit on some other potential planning ideas, some of, just again, as we're here at year end, just some things to think about. If you've come to these sessions in the past, there probably is some repeat items on there, but that doesn't mean they're not good planning. So we'll talk through that a little bit. Then a slide or two on post-election possibilities. I really don't, we won't probably spend too much time there because we really don't know what's going to happen, but we wanted to at least put forth, some of the items that we've heard that, based on what's coming out of Washington, things that have been thrown around, to at least kind of, get some information, get some data on some of that's floating around. But again, none of that is certainly concrete and guaranteed. And I think 2021 will be a very interesting year all the way around, but certainly in the tax world for sure. So with that as our agenda, I'm going to turn it over to Kevin to kind of walk through the PPP information, and we'll go from there.
Thanks, John. Thanks, Chris. As Chris mentioned, I am Kevin Halls. I'm a tax manager here at Holtzman Partners, and I've been here for about 2 years now. If I haven't met you yet, it's a pleasure to meet you all virtually. I hope that I can meet you in person sooner rather than later when this is all over. Hopefully, like I said, hopefully pretty soon. So I want to start off today and talk about the Paycheck Protection Program, or the PPP, as pretty much everybody knows it as. Back in March, the world was obviously brought to its knees with the coronavirus pandemic, and the government needed a way to help out small businesses, and they needed a way to help out medium-sized businesses as well. And what they did is they had the CARES Act, but they also had the PPP, which is, like I said, the Paycheck Protection Program. And what that is it's available to companies with 500 or fewer employees, and that includes 500 per location. If it's an accommodation or a food services type, if it's restaurants or hotels or something, it has to be 500 or less per location. And then there's also going to be the loan amounts can be the lesser of $10 million or 2.5 times your monthly payroll. So it really isn't going to be for that large of companies, obviously. And the current state is that as of August 8th, 2020, the SBA had approved about 5.2 million PPP loans, totaling more than $525 billion, which is obviously an astronomical amount of money, but I think it was actually put to really good use. The average size of the loan was approximately $100,000. There was about 29,000 loans or so over $2 million. There was about 3.6 million loans that were 50,000 or less, just to give you an idea of how big or how small some of the loans were. And just like I said, the current state, the covered period is going to end on December 31st, and we'll actually get into the covered period here in a minute. So we have our first polling question, and it's a pretty obviously simple question. And the question is, did your organization receive PPP loan? Now I will start the polling, and when we get, see how fast we can all answer this question. Let's see, we're already at about 91%. Wow, that's pretty quick, 94%. So, oddly enough, about 51% said that they did receive it, and 39% said they did not, and 10% said they didn't know. I was actually thinking that when I was rehearsing my speech, I was thinking that, maybe it was going to be about, I was thinking about 80 to 90%. So that's interesting. And I'm going to go ahead and end the polling for that. All right. And so the next one would be, so we want to talk about we want to review the loan forgiveness. As many of you know, part of the loan process was that you could actually get the loan forgiven. And that process is kind of starting now. The loan forgiveness applications are going to be through the same, probably pretty much the same bank that you got your loan from, but it's going to be an SBA form 3508, and the 3508 is going to be for companies that have larger loans and that have, calculations in there that are going to be dealing with wage reductions, or they're going to, their employees fluctuated throughout the time. The 3508EZ is going to be the easy form, and that's going to be for companies that are a little bit smaller loans, and then they didn't have any type of employees leaving or anything like that. And the 3508S is for companies with $50,000 or less in loans. You can file at any time before the maturity date, and the loans issued prior to June 5 have a maturity date of 2 years, and if it was issued after June 5, it has a maturity date of 5 years. So the loans will be deferred for borrowers who apply for loan forgiveness until the SBA remits the borrower's loan forgiveness amount to the lender. And as we discussed earlier, the covered period is going to be for 8 to 24 weeks ending on December 31st. The covered period is the time in which you're going to need, if you had this loan, this is the time in which you're going to need to spend on those wages or the other items that we're going to talk about in a second. But basically the covered period, you have to have paid everything in that period. It can't be after. So what are the qualified costs? The qualified costs for the loan forgiveness are going to be your payroll costs mostly. So one thing to note is that 60% of the loan needs to be used to pay for payroll costs. You can also use it for other items down below, but it's going to make at least 60% needs to be for payroll costs, because the reason that they wanted to do the payroll protection program is so that people weren't going to be out of money. I mean, that they weren't going to be out of a lot of money, I guess. The payroll costs are going to include gross wages, health insurance, and retirement plans. For business mortgages, business mortgage payments, that's going to be, your personal property mortgage, that's going to be for a heavy piece of machinery or something of that nature. The business rent or business lease payment, that's going to be your rent. And there is going to be limits on related parties, meaning let's say that there's Kevin Corp, and then I own the office building to which my office is at, it's going to be Kevin Real Estate Corp. Well, they're going to limit that because I'm basically paying money myself. So they're not going to let that fly. For these qualified costs, you're going to need to provide some documentation for all the payroll periods that overlapped with the covered period. And so you're going to need to have bank statements, tax forms, which are going to be your payroll tax filings, and payroll costs do not include independent contractors. I think that's a pretty good stipulation, but that's just something to be aware of. So one thing is that they're not going to, if you're going to have wage reduction, and this is going to apply to the covered period salary or hourly wage if it's reduced by more than 25% compared to Q1. They're not going to ding you 100%, meaning let's say that you had $100,000 in wages on Q1. If it dips below 74,000, they're not going to penalize you completely. And so I do like that. They're going to exclude any employees that made $100,000 on an annual basis in any of those pay periods. And when you're determining compensation, you're only going to take into consideration salaries and wages. And what that means is, back where it said you could use it to pay for other, for retirement or health insurance. What I think is that you're not going to have to take that into consideration for this. Now, if you apply for forgiveness, I think this is another important stipulation. If you apply for the loan forgiveness before the end of the covered period, any wage reduction must be extrapolated over the entire covered period. Meaning, if my fake company, Kevin Corp, applies for loan forgiveness on December 1st, when it comes to you can't go ahead and drop your payroll on December 2nd and be okay. It's going to be the whole covered period. So there are some PPP reduction safe harbors, meaning that with the wage reductions, if you restore the annual salary or hourly wage to February 15th, 2020 levels as of earlier of loan application date or December 31st, 2020. And then the full restoration is allowed, not just 75%. There is an FTE, which is a full-time employee reduction business exceptions. I'm going to go to the next slide. Actually, I like that one a little bit better. So what this means is there is going to be a safe harbor. So if you were unable to operate between February 15, 2020 and the end of the cover period at the same level of business activity as before, due to direct or indirect compliance with COVID requirements established or guidance issued on March 1st, 2020 and December 31st, 2020. What that means is that if you like, I guess, let's think back, it was, I guess, April or May, Governor Abbott came out and said, hey, you know, we're shutting things down and only the essential services are going to be able to go to work. I do have a slight bone to pick. I'm still not quite sure how accounting was considered essential service, but you know, we'll have to let that one slide. So if you were in a group that was a non-essential, then you're not going to be dinged for the entire amount, which is a good thing. I like that. The next, and I think the most important thing you should take away from this today is the income tax treatment of loan forgiveness. So the CARES Act did establish that there will be no cancellation of debt income related to the loans forgiven by the SBA, meaning that let's say that you're you're at the average of $101,000 in loan, and you do everything right, and that $100,000 is forgiven. Well, what they're saying is they are not going to increase. You're not going to have $100,000 in extra income. However, it's a little bit of a catch, right? So you're not going to have $100,000 in income, but you're not going to, as it stands now, you're not going to be able to deduct those wages that you paid for using loan money as part of your taxable income. So what's going to happen is, let's say you have $200,000 of income for the year. Your wages were $100,000. Your net income is not going to be $100,000. You're going to increase it. You're going to not get that deduction. It's going to be $200,000. It's a little bit. It's weird to say it's not cancellation of debt, but at the same time, that's just kind of how it's going to be right now. Now, one slight issue is that we don't know if Congress will overturn that. Who knows? I would go into the next year as thinking that you're not going to be able to deduct that amount. That, like I said, that could change. And one last thing is that you need to, if the taxpayer is going to reasonably think that the loan is going to be forgiven, you're not going to be able to deduct that. And I would go ahead and say that if you think it's going to be forgiven, you should go ahead and take that out of your income for the year. So with that, I'm going to throw it back over to John so he can discuss opportunity zones.
All right, thank you, Kevin. Yeah, that I think you're right. I think the main takeaway from that first section is really that last slide you were just on. It's really it seems a little counterintuitive that they're not letting us, at least as of right now. The IRS is saying you can't take those deductions. We don't know what's going to happen, but what we hear and see is, you know, both parties don't agree with that, but that doesn't necessarily mean the IRS is going to change their mind. So I think that's unfortunate. And one of those rulings, I think, just came out just a week or so ago. So that's all pretty new, and we'll stay tuned and see what happens from this point forward. But I think that's probably the most interesting point. Okay, we talk about opportunity zones a little bit. Maybe, Kevin, we can flip to the first slide. So really what opportunity zone credits are, they came out again in the Tax Cuts and Job Acts a couple years ago. So it's not brand new, but like I said earlier, it's really starting to kind of get some real traction here, as you can kind of see from these bullet points here. You know, these are big dollars, and they really are being utilized. And just kind of at a high level, what was the intent behind this? Is really to spur investment to kind of undercapitalized communities and undercapitalized areas around the country, by giving tax breaks. So if you have to have a capital gain, and if you've got one that's in an investment that's unrealized at this point, obviously we all know the general rule is if you trigger that economic event and you have a cap gain occurrence, then you pay capital gains tax on that. And what this provision is trying to do and to incentivize folks to maybe invest in some lower income, poverty depressed sections is, hey, invest here and we'll let you either reduce your capital gain taxes, or maybe even wipe the whole thing out if you hold it long enough. And so, I mean, that's really kind of the genesis behind it, is trying to incentivize folks that may have some cap gains, that to avoid taxes on that, but invest in some areas that maybe don't normally get that type of capital attention. There's about 21 communities here in the Austin area. Most of them are on the east side of 35. But we've got a lot just sitting here in our local backyard, but close to 9,000 across the U.S. So it's really a powerful tool. Again, just like a lot of things in tax law, if your specific facts and circumstances fit, this could be something that could be quite beneficial. So, okay, let's maybe flip to the next slide. So this talks a little bit of the opportunity zone basics. It cannot be a related party transaction on the cap gain. You've got to reinvest within 180 days of having it. Now I think on a couple of slides later that they did with COVID, they came out with another kind of rev ruling or IRS notice that deferred that a little bit more, but the old rules where it had to be done within the 180 days. So how do you do this? You first have to create a qualified opportunity zone fund. So you set up an actual entity. It can either be a partnership or a C corp. You have to open up this fund. That's where your cap gain actually goes into. So it's a taxable entity. You do a tax return for it. Again, if it can be a partnership, but it's got to have at least 90% ownership. It needs to be in the depressed area. So you can't have other partners, but it can only be 10%. So first, step one is you open the fund. Step two, find the zone that you would like to invest in. And then step three is invest that capital gain in the business. Most of them are commercial or industrial real estate, maybe some housing and other infrastructures. But most of what I've seen is that it's mostly in the real estate world. And that, at least in this area, that's what I think see most of. The invested gain deferral until 2026. So if you get all this in place, if you go through the steps, you open the fund, you find the zone, you invest in the business, you do everything kind of by the book, then really you get to place that asset into the fund, and it's not taxed until 2026. There's an additional 10% discount if it's held for 5 years. And if you hold it for 7, you get to bump that on an incremental 5% discount. And if you actually hold it for 10, the whole capital gain just is completely eliminated. So I think that's, again, if you have specific facts that fit, that's a pretty powerful planning tool. And there's lots of arms and legs on this topic. We're just obviously just trying to kind of hit the basics and talk through, but wanted to just kind of make everyone aware of it, and if it fits, it can be helpful. Okay, thanks. The next slide. So final regs were released about a year ago. This IRS notice, which I was referring to a little bit earlier, this 2020-39, actually extended the deadline to the end of this year. So just, here, I guess, in about a month, that extended the 100-day investment of cap gains if the cap gain period, the 180-day period, ended on or after 4/1/20, which is obviously coinciding with kind of the COVID world that we've all become accustomed to. So again, lots of details and specifics in this area, but these are some of the high points and the highlights of it. So wanted to bring that to y'all's attention. Again, not just a specific 2020 item, but certainly seems to be building momentum this year.
Absolutely, John. It's nice if you have time and money. So the next, we have a polling question, and I'm going to go ahead and launch the polling question. But the question is, prior to this training, I was well informed about the opportunity zone investments. Yep. Can you see that, John? About 92% have answered, and 92% were not well informed. That doesn't really surprise me. It's not a very talked about piece of legislation.
Yeah. Well, hopefully the next question we would ask is, after this presentation, am I now well informed? That would answer it. But yeah, well, it's good I'm glad that we at least put the topic in the agenda. And obviously, if anyone has any specific questions that we can take offline at some point, we'd be happy to chat more with you in an individual situation. So good. All right.
I guess next one.
Yeah, I'm gonna just close the polling question since it was in the middle of my screen. Okay, so Wayfair 2 years later. I think we probably all remember Wayfair, or maybe I just do because we live in this tax world every day, and this is pure excitement when you see something. Supreme Court case dealing with taxes just gets us very excited. So, really what Wayfair was, just as a reminder, the rules before Wayfair were really more about physical nexus and physical presence. And if you had a physical presence in a state for sales and use in state income, you had nexus, and you had filing requirements, registration requirements, all that kind of stuff. Wayfair, even though a lot of states were doing things, probably introducing economic nexus before that, it wasn't really codified or in the legislative kind of history until Wayfair came out. So what Wayfair really says is economic nexus. You don't have to have a person or a building, in the state of Wyoming, but if you make sales there, you might have nexus there, and you might have some filing requirements. So that's really what Wayfair again was all about. Now, 2 years later, what we're seeing is a lot of people have addressed this, and I'm sure a lot of your companies probably have. Maybe you've done some nexus studies, maybe you've done analysis, and you're watching those thresholds and doing and following that. But there's also, I think, quite a few companies that have not yet, and maybe it's not material yet. So ultimately, there needs to be a business decision there. But maybe it's not material, so it hasn't caught quite on the radar of the company. But it's still there, and it's real, and it's not going away. So let's go ahead and switch or advance to the next slide. So again, here we are 2 years later. 45 states plus DC have a sales tax. 43 plus DC have enacted economic nexus reporting requirements. So that's a pretty high percentage, obviously. Florida and Missouri have not adopted economic nexus reporting. And then 43 states have enacted this marketplace facilitator collection requirement. So I guess the takeaway just from this slide is it's not 100%, but it's pretty darn close. That an analysis probably should be performed to see what requirements do y'all or the companies particularly might have. Okay, we can advance. Top marketplace drivers for sales and use tax. Certainly look for states to be extremely aggressive post-COVID. I mean, states obviously, just like everyone else, struggling, seeing significant fall in revenue, and a lot of times where they can gain some traction in the sales and use tax space or the state income tax space, they're going to do it. So we're really expecting probably more attention from the taxing authorities of the states and the local jurisdictions. And like that last bullet point says, confusion around sales and use tax liabilities and collection and remittance. There's just a lot. There's 11,000 jurisdictions across the country, state and local, more than 60,000 rates and rules. I mean, that is a lot to get your arms around for a business, especially like a lot of our Austin-based business and clients are obviously tech related, and there may not be a lot of physical presence anywhere, but you may have sales and you may have economic nexus in a lot of places. So anyway, that's sort of what that slide's getting to. Impact of business, we've talked about some of these kind of already, but certainly significant impact to all businesses, really, of all sizes. And it's confusing, and the rules are because you got different states that apply different rules to different revenue streams. So in the state of Missouri, something a particular service might be taxed, but then in Illinois it might not. So it's a real analysis that needs to go through, and takes a lot of time. Physical presence still a standard for Nexus. So if you've got physical presence, certainly you would say you have Nexus in that state, for sure. And then you need to kind of go through the analysis of what does that mean for me and what do I need to do with that information. Okay, next slide. A little bit, just a few more. We don't necessarily need to probably read through all of those. The one point, the last two bullets, I wanted to highlight a little bit. So the VDA program, the voluntary disclosure agreements, and for those of you who don't know what that is or not too familiar with it, basically it's getting right with the state. So let's say you've been in the state of Texas for the last 5 years, and you probably should have filed some sales and use tax returns, and you probably should have collected and remitted, but it hadn't been that material, but it's ramping up, and now the current year is really, you're like, we need to get this right. So you'd like to be a good citizen and go back and and make it right for the prior years too. That's what the VDA is for. But there's a certain order to doing it, and what this bullet point is saying, if you just simply start registering for sales tax collection right out of the gate, the state now knows about it, and now they can deny kind of your entrance into the VDA program. So there really is some steps, and we and others can certainly help with that. But there's an ordering process to go through, that hopefully you again wanting to be the good citizen and get right with the state, but there's a certain way to do that. In the last bullet, buy and sell M&A on due diligence side, we've seen this several times lately, in the last year for sure, where you've got a transaction and there's unrecorded sales tax liabilities, and there was never really a nexus study done, and all of a sudden you got $500,000, potentially of unrecorded tax liabilities that have now been uncovered during the quality of earnings study or due diligence work, and it can be a real issue. I can think of at least two jobs or two projects that we worked on that was the biggest issue after we got through everything, and it was we came in to kind of just help from the due diligence side and brought that attention. But it can be real. I mean, obviously depends on your industry and depends on your size, but it can be a material item. Okay, This slide just really talks about quantifying risk, you know, just spreadsheet it out basically. We're all accountants, I think, or at least finance related folks would probably love spreadsheets and formulas and laying all this out, and pivot tables and the works. So, you know, really it's an analysis, just like a lot of things, of, you know, where's the risk, where's the exposure, you know, look at this, calculate things out, and then try to make some decisions from there. So I would say the takeaway from the kind of the Wayfair section is it's still alive and kicking. It's basically everywhere. Again, as we said, almost every state that actually has sales tax, you know, has now implemented, you know, economic nexus reporting requirements. It's not going anywhere, and it's a little bit of a bear to kind of wrestle down, but it's, especially as you're getting further and further embedded in other states as your businesses grow, just something to always keep on your mind, I guess. So I think that's the last slide for that one. Okay.
Yep.
All right. I'll kick it back to you, Kevin, for this part.
Thanks, John. So we're going to talk a little bit about the CARES Act tax planning. And if you all remember, the CARES Act, like I said, came out in March 27, 2020, and that's when it was signed into law. And there was a couple of key tax issues that came out of this. First were changes to net operating losses, deferral of Section 46I business interest loss rule, and that we're not going to go and talk about code sections, I promise. And then the retail glitch fix for qualified improvement property. I don't necessarily know if I'd call that a glitch. It's more of a whoopsie by Congress. Then nearly every state with corporate or personal income tax relies on the Internal Revenue Code in some way. Texas does, but we don't really, not actually, Texas doesn't, so we don't have any type of income tax for corporations or for personal, so that is good. We don't really have to worry too much about that here. So first off, the NOL rule changes. So I guess let's rewind a little bit back to 2017 or 2016, back whenever Trump got elected and he wanted to pass his tax cuts, right? Well, what he really wanted to reduce the tax rates, obviously. And so he did reduce the tax rates, but that money, the lost revenue, it has to come from somewhere, right? And so some of the things that they did were they went to NOLs and they said, you used to be able to deduct 100% of it, or not deduct, you used to be able to offset 100% of your taxable income. And what they did then is you could only deduct, or you could only offset 80% of federal income tax. So let's say year one, you had, $100,000 loss, and then the year two, you had $100,000 in income. You could only actually offset 80,000 of that because of the 80% rule. And what the CARES Act did is it came back and said, hey, we need people to be able to go back and take some of those losses that they had previously taken, or if they created losses in 19 but had income in 18, they need to be able to go back and take those losses. And so that's what that did. Is it also, like I said, you could take it back 2 years, and we've actually done that for, I guess, 2 or 3 separate clients, and it's actually been a really big tax savings for those clients. Let's see. So the corporate income tax, despite the 3720 code conformity, 5-year carryback is limited in Alaska, Delaware, Maryland, Missouri, and Oklahoma. I don't deal too much with Alaska, Delaware, some Delaware, Maryland. We get some Missouri and Oklahoma stuff, but not a whole lot here. The next one is going to be the excess business losses. So pre-CARES Act, effective for tax year 2018, this is actually another part of the Tax Cut and Job Act, was that business income loss must be netted, and only 250 to 500K net business loss could offset non-business income. The excess was going to be your NOL carry forward, right? So basically, if a person had, $2 or $3 million in NOLs for their personal return, they could only offset $500,000 if they're married on those returns. In the CARES Act, that provision was suspended until the year 2021. So you'll basically get it for 2020. The state issues, there's only rolling 32720 code conformity. States could follow this suspension, but some of them haven't. Most of the states have declined to decouple. And then we got the next slide, like I said, is going to be the qualified improvement fix. So this was actually, like I said, this was a pretty big whoopsie by Congress. They wanted everybody to be able to take 100% bonus depreciation, and that's what they intended the law to do. However, whenever it came to putting the pen to the paper, they forgot to add this in there, and the 39-year property was ineligible for bonus and ineligible for 179 due to, or it was eligible for 179, but it was, they did this, and basically you want to be able to deduct bonus for the 15-year property, right? Well, let's say you had $1 million, you bought $1 million piece of property, or you fixed something up for $1 million, right? Well, before the CARES Act, you could only deduct, I think it was like $26,000 of that a month, or not a month, a year for the next 39 years. Well, the CARES Act came in and said, no, we're going to make it to where you can 100% bonus that, and that's actually obviously pretty large savings. So we've actually done that and done a method change for some of our clients. We went back and did that, so we were able to take that 100% bonus. So if you haven't done that and you didn't even know about it, let us know, and we would love to work on that and help you out. The federal procedural issues, amend the 2018-2019 return, like I said, file 3115, which the 3115 is an accounting method change. You report the impact of that 2018-19 during the year of change. And again, I kind of like John was saying, that the states are so different. You just really need to follow kind of what's going on with the states, because every state is completely different, and you just need to look into that. The next slide is going to be about the business interest limitation. So for tax years 2019 and 2020, this temporarily is going to increase the amount of the deductible interest from 30% of taxable income to 50%. And then let's see, the charitable contributions. I thought this was kind of funny, but I guess I hadn't been paying attention and didn't know this. But it allows taxpayers utilizing the standard deduction to claim an additional above-the-line deduction of $300 for cash contributions to certain qualifying charities beginning in 2020. So if you make a $300 deduction to one of those charities, you'll get an above-the-line deduction of $300. So I mean, that could save you $100 in taxes. So while it's not going to be the greatest tax saving strategy, it's still something you can do. And they're going to suspend the limit on deduction for charitable contributions for taxpayers at itemize in 2020. And they're going to increase corporate charitable deduction limit for 2020 up to 25%. That's actually up from 10%. So that's something else that you could take advantage of. Also, for retirement funds, they're going to allow individuals. They may withdraw up to $100,000 from your retirement accounts with no penalty if you repay it over the next 3 years. I think that's a pretty cool avenue if you are needing money. It's actually pretty cool if you needed that extra $10,000 and you had to make it to the next couple of months or something. They say you can take it out of your 401k free of penalty. And then retirees have the option to waive required minimum distributions for 2020. That's kind of just a high level of what the tax strategies were, the tax planning ideas that you could have from the CARES Act. Let's see here. Other potential planning ideas. I think John and I was going to talk a little bit about this.
Yeah. Thanks, Kevin. No, we just wanted to talk a little bit about just some other items. Again, some of these are not. Well, all of them really are not brand new or, just came out in 2020, but still, again, good planning items that might be out there for y'all to consider. We'll run through them a little bit here in our remaining time. Reasonable comp study. We're seeing more and more of these type of questions, especially for S corps. Those are y'all that are S corporations. We know there's this push and pull between what's my salary, the owner's salary, versus the profit of the business that gets distributed and kicked out on the K-1. There's again a push and pull because of the FICA requirements there. So if you're the taxpayer, you'd rather have a lower comp number, a lower W-2 amount, and have more on your K-1 because you can avoid some Social Security tax, payroll taxes, etc. But the IRS wants that, would like that to be higher. So I'm seeing more and more reasonable comp studies because there's really no bright line test anywhere. It's really kind of a reasonableness and a rules of thumb and things like that. So we again are seeing especially S corps, especially closely held S corporations. The reasonable comp study might be something beneficial to be done to help you solidify your position on your wage versus your K-1 reporting. Just overall fixed asset analysis, section 179 and bonus. Kevin mentioned the qualified improvement property glitch that was fixed during the CARES Act. That's a piece of this too. All this really is just a catch-all for reviewing and maximizing and optimizing your fixed assets as much as you want, or as much as you're allowed. So that's always a good, if you're fixed asset intensive, obviously the more opportunities that you have to to create and accelerate more deductions. So usually that's a really good time to spend some time here before 12/31 looking at that. Just overall tax accounting methods review. Do I need to be on unicap? Do I need to be accrual versus cash basis taxpayer? How am I treating my prepaids? How am I treating my deferred revenue? Just kind of a scrub, because we all know there's book treatment, GAAP treatment, and then there's tax treatment, and I think sometimes the by default it's easy to, well, the books do it this way, so let's just follow books. But there might be a more advantageous way of doing something, or some of these methods that doesn't do anything, doesn't change your book income, doesn't change anything to do with your financial statements, but maybe it can lower your tax liability or your tax burden. So really, that's just again a catch-all around just overall tax accounting methods review. R&D credit, one of the few permanent items that are out there. There's probably a lot of companies, I'm assuming folks on the line are dialed into this that maybe have done this already. There's some newer rules. I probably shouldn't say new rules anymore, because 2016 was eons ago, it seems like at this point. But there were some newer rules that came out in 2016 that allowed smaller startup companies, even if they've never paid a dime of income tax, to create the R&D credit and then offset payroll tax. So obviously, if you have employees, you have payroll taxes, and that's real cash going out the door. The old rules for the R&D credit prior to 2016 was, if yes, you may qualify for the credit, but it was really more of an academic exercise. It would just really get captured in a carry forward, because a lot of companies, a lot of Austin companies, of course, there's a lot of tech companies here, a lot of startup companies. So you got a lot of companies that are in losses. They're not paying income tax right now, and maybe not even for the next few years. So if you did the R&D credit calculation, if you went through that exercise, that's great, but it's just a carry forward, and it doesn't really help you monetize that until you actually have income tax liability. So Congress or the IRS put this into play for the specifically for smaller startup companies. So you've got to be within your first 5 years of having gross receipts. That's how the IRS defines a startup company. So years 1 through 5, where you have gross receipts of any, could be $1, could be $5, but that counts. There's no de minimis. And then you have to be under $5 million. So as soon as you cross, if you're $5 million and $1 in a particular year, you're too big. So you've got to be small and you got to be a startup. So the way they define small is less than 5 million. The way they define a startup is your first 5 years of having gross receipts. So that again is obviously a powerful tool if the facts and circumstances fit, not only on the Fed side, but Texas franchise tax, it can help offset as well, because we all know, again, Texas doesn't have an income tax, and you may not pay federal income tax, but you may be paying a Texas franchise tax even though you're in a loss, because the Texas franchise tax is really based on receipts, not income. So it could be a real nice benefit potentially on the Texas franchise tax world. And there's other states out there, lots of other states out there that have the R&D credit as well. They're all, just like Kevin and I have talked about earlier in the presentation, they can be all over the board in the way they define R&D, the way they calculated R&D, and the way they apply R&D. But just something to keep in mind, that kind of put on your end of the year kind of checklist of should I think about this, and can I create any value from this. Okay, next slide. A couple more. Qualified small business stock. This is if I know we said we wouldn't say code sections, but this is commonly referred to as 1202 stock, section 1202. Basically, again, if your facts line up, and you can exclude 10 million or 10 times your basis on a gain. So basically, you do have to be a C Corp, and you do have to hold that C Corp stock for 5 years, originally issued stock. For 5 years, and if you do that and you sell, and there's other rules. Again, we're kind of talking at the general level. There's certainly detailed arms and legs that we can kind of go through on a specific situation. But the general rule is, if you have originally issued C Corp stock and you hold that for 5 years, then you sell, you have the opportunity to potentially exclude up to $10 million of gain. And that's exclude. That's not at a reduced rate. That's not at half the rate. That's literally no tax on that first 10 million bucks, or 10 times basis, whichever is greater. Entity structure analysis, just really kind of a catch-all. I'm a partnership. Should I be a partnership? Maybe I want to take advantage of the qualified small business stock. That only applies to C Corp. So should I be a C Corp? Should I be a sole proprietorship? I mean, that's really just kind of another end of the year exercise of, am I structured correctly? And in a lot of companies, of course, are starting up. So like the answer to that in year number 1 might be different than year 2 or year 5 as your business grows. So I think that's another item to kind of just keep on the tickler. Am I ready to buy or sell a company? I mean, if I am, do I sell my stock? Do I sell my assets? If I want to buy, should I buy stock? Should I buy assets? Just all those sorts of questions and items as well. So again, those are just food for thought. I don't, some of these I think have appeared in prior presentations, and will probably continue to be in future ones, but because they're good information, good planning tools. So we'll move. I know we're coming down to the wire, and the last thing we want to do is keep you guys late or keep you guys long. So we'll definitely get off here by 3, if not a minute or 2 earlier. But wanted to talk a little bit about post-election possibilities, and at the end of the day, who really knows what's going to happen? This is the craziest year I think ever, as we've already said several times. But in the political world, the control of the Senate, I think we all know, is going to be determined by those runoff elections in Georgia here in a month or so, I guess, and that will really be a big item as to whether we've got a balance of power, or if it's all going to be on one side or the other. So, I mean, I think a lot of maybe the next slide or 2 is going to depend on how that looks.
I agree, John. I think it's, not to get political, but I think that whatever happens, I think if the the Senate remains with the Republicans, I think it'll pretty much be a stalemate for at least for 2 years. I don't think much will get through, and I don't think that we can expect too much tax issues to come out of that. But that's just my opinion.
I agree. I mean, that's what we're certainly hearing from our Washington connections, and kind of goes into this first bullet point here, is that we've got bigger fish to fry right now with COVID, and first priorities are battling that and maybe providing more stimulus and some relief. No matter what side you're for or on, I think we probably all agree it's not immediately you want to come out on day one and just immediately raise taxes across the board when we're dealing with COVID out there. Again, key Democrats have indicated that maybe the increases should wait until the economy is less fragile. There's been some talk on retroactive tax increases, meaning like going back to 1/1/20. Again, those are extremely rare. They have happened before, but everything that we've heard and read is that's pretty rare and would be pretty doubtful. So let's go to the next slide.
We have our next polling question, actually.
Okay.
And let me go ahead and launch the poll. So what information from today's webinar is most applicable to your current business?
Interesting. Okay.
Yeah, I thought so too.
We're almost to 90%, 88, 89. Okay, 90%. So we're over 90% voted now, and that's pretty, wow, that's quite evenly split. PPP and the CARES Act are dead even. Literally 34% each. Wayfair 26%, and then Opportunity Zone 5%. Then that makes complete sense. I mean,
yep, that makes perfect sense.
Yeah. Okay. All right. Awesome. We'll just take this last couple of slides real quick. Potential impact to individuals. This is under President-elect Biden. Some of the things he mentioned during his campaign. Raising for over $400,000. So what he basically says, anyone under 400,000 shouldn't be any raise in taxes. But if you're over 400, this is what they're contemplating: raising the rate, capping itemized deduction, phasing out 199A, which is really the QBI, or the qualified business income deduction. Taxing gains, capital gains, once you get over $1 million, they're going to not give you a favorable capital gains rate. It's going to go straight to ordinary. Also, bringing Social Security, the piece tax back on, not having a full phase out, basically. Once you get over 400, they're going to restart your Social Security. And then return, this could be really big for a lot of folks. I mean, return to state taxes to historic norms. I mean, right now you're at, I think it's 23-ish million as a couple, married filing couple, and that covers a lot of people that can be under that. But they're talking about knocking it back down to 4 or 5 as a couple. That's a big difference. So these are just some things. I'm not saying please don't think this is exactly what's going to happen. These are just some of the things that were mentioned during the campaign. And then this last slide shows a few more. Maybe the corporate rate to 28%, etc. So that's really all we had. I think I showed 259, so we beat the buzzer there. But we really appreciate everyone's time, and hopefully you got something out of this besides just an hour of CPE, if nothing else. So we all need that. So thanks very much. If you have any questions one-off, feel free to, I think Kevin and I contact information maybe is on the first page or the last page, or there it is. Feel free to reach out. We'd be happy to chat. And that's all we have. Thanks
everybody for joining. And one last thing, make sure that you know that we have 2 more webinars, and if you hit the link, we'd love to have you all attend those as well. And we appreciate y'all's time.
Thank you. Bye-bye.
Thanks everyone.